Good day. Welcome back to our new session. In our previous session, we covered the November 2019 exam paper, where the main focus was more on the knowledge or principles that we've covered in the previous lectures or previous sessions that we had. The main focus was more on question 4.1 and 4.2.3, which was specifically focusing on retained income as well as share repurchases, right? So in this chapter, we're going to cover more on adjustment for financial statements, right? Let me just increase the screen so that it can be clear from your side. So as I said, this chapter we're going to cover adjustment to financial statements, and the adjustment that we're going to deal with in this chapter is income received in advance, accrued expense, prepaid expenses, and debt management. Debt management comprises of provision for bad debts covered, and bad debts. So why adjustment? Remember, accounting is about making sure that you account for all the transactions that occurred in that financial period, right? So it's very important to ensure that your financial statements are accurate, that is, they are free from error or they don't have any incorrect information being presented to them. So adjustments aim to achieve that purpose. The first adjustment that we're going to look at is income received in advance. Income received in advance, this is when income is received by the company, and by the last day of the financial period, the company has not provided the service or goods to the customer, right? So we'll elaborate this using an example. So say company A has a building that it rents to Superstore Groceries, also known as SSG, for a monthly rental of 15,000, right? Then it happened that on the 1st of June 2021, SSG paid the rental of 180,000 for 12 months period ending 31 May 2022, right? Then the financial year end for company A is 31 December 2021. Then we ask, what will be the journal entry processed on the 1st of June 2021, and also what will be the journal entry as at 31 December 2021, right? So when the company received that 180 on the 1st of June, it's going to say debit bank. Remember, when the company receives cash, it's an increase to your bank account. Remember, you said a bank account is an asset increase where on a debit side. Then be a credit rental income, because rental income is your income, and income received increases on your credit side, right? That's the 1st of June. Then on the 31st December 2021, the company will need to make sure that it made an adjustment to that rental. Remember, from the 1 June until 31 December is going to be 7 months: June, July, August, September, October, November, December. So it's 7 months, whereas they paid the rental for 12 months. So it means the other 5 months needs to be adjusted as it fall in the next financial period. And as in accounting, only account for transactions that occurred or covers what that particular financial period, right? And we're told that the financial period ends on 31 December 2021. Thus, that rental income that was recognized of 180 need to be adjusted. Adjusted with how much? 75,000. How did they fund it? They say 180,000 divided by 12 times 5. 5 months that the company has not provided that rental space, right? So it's going to say debit rental income, because initially it was a credit of 108. So we need to adjust it. We reduce it to by 75,000, right? Then we say credit income received in advance. Income received in advance is a liability. Why is it a liability? Because the company is having an obligation to either pay back that 75,000 and or provide the rental space to SSG, right? So that's how the adjustment needs to be processed for income received in advance, right? So we are going to look at what will be the impact on the statement of profit or loss, right? Remember, your rental income for the company A is going to be part of other incomes. So it was 180,000 that were received, then disadjusted for 75,000. Then it means the rental income that is being generated for that financial period that ended on the 12th December 2021 is going to be 105,000, right? Then on the statement of financial position, remember we said that 75,000 is going to be a liability since the company has got the liability to either pay back the money or provide the rental space. And it's going to be provided the rental space within the next 5 months after the financial year period. So under classification is going to be current liabilities. Why current liabilities? Because we said current liabilities are those liabilities that are going to be realized or settled within the next 12 months, right? And as I told you, the rental is going to be, the rental space is going to be provided in the next 5 months. So it's going to be under trade and other payables, 75,000, right? Then when it comes to notes to financial statements, note is all about providing more information to users to see what happened. Because when a user is only looking at trade and other payables, is not sure what payables does this 75,000 comprise of. That's why they say note, because under trade and other payables, there are certain things that forms part of it. So that's why there's under trade and payables. If this was the only transaction, we expect to see income in advance of 75,000, right? So your user will be able to say, okay, the company has got current liabilities and those current liabilities are trade and other payables, but what does this 75,000 relate to? Then you'll be able to see under the notes that it relates to income received in advance. That means the company received received cash, but it has not provided that goods or service. In this case, it received 180 and it only provided the rental space for 7 months, but not for the remaining 5 months. Yeah. Then the next one that we are going to cover is accrued expenses, right? So this is when the company has received a good or service from the supplier, but has not yet received the invoice, right? So this means the transaction has not been recognized in the accounting records of the company. Because what usually happens is, in order to record the transaction, the company will need supporting documents, right? In order to support that transaction that has been recorded through a journal, right? So if the company has received a service, but there's no invoice, it means the transaction could have not been recognized in the normal operations, right? The normal accounting processes that have been followed in a company, right? But we're going to elaborate this more using an example. Say company A entered into a telephone contract with Telecom, right? And the telephone bill for December 2021 was not received. The monthly telephone bill is 4,000, right? And the financial year end is 31 December. Then we're asked what journal entry will be processed to account for this transaction, right? So the journal entry is going to be debit telephone. Remember, telephone is going to be an expense of 4,000. Expense increase where on your debit side, 4,000. Credit accrued expense of 4,000. Why accrued expense? This company is received a service, which is the telephone from Telecom, but it has not paid that amount since it didn't get the invoice, right? So it has got an obligation. A liability is an obligation to make a payment. So it has a liability to make that 4,000. That's why we have to recognize that 4,000. Then on the financial statements, especially for statement of profit or loss under operating expense, because this telephone is an operating expense. So we are told that the telephone cost each month is 4,000. So it's 4,000 times 11 for 11 months, right? Plus the 4,000 that is an accrual, meaning it is not, there is no invoice that has been received, even though the service has been received, right? Then the telephone expense is going to be 48,000. Then in the statement of financial position, same concept under current liabilities. Why we say current liabilities? Because that telephone expense is going to be paid within the next 1 month. Usually it takes 1 month after they receive an invoice, right? Then it's going to be under current liabilities. Same concept, it's going to be under trade and other payables, but the user won't be able to see what does this 4,000 relates to, right? But then you have to look at the note. So under trade and other payables notes, there'll be an accrued expense of 4,000. So the user will be like, okay, the company has got current liabilities and these are trade and other payables, but what does this relate to? Then it goes to notes to financial statements. Under trade and other payables, you see accrued expense. From the taxpayer, from the what do you call, from the user financial statements, you'll be able to say, okay, it means the company has received the service but has not paid this amount, right? Then that's where we see the 4,000, right? Then we move on. The next one is prepaid expense. Prepaid expense, this is when the company had paid for goods or service to a supplier, but on the last day of the financial year, the goods or service has not been received, right? Then we elaborate this using an example. Say, for example, a company A paid insurance premium for 12,000, right, for a 12 months, beginning 1 March 2021 to 28 February 2022. Right? Then the financial year end for the company is 31 December 2021. Then we are told what journal entries will be processed on 1 March 2021, and also what journal entries will be processed on 31 December 2021. Right? So on 1 March 2021, when the company make a payment of the insurance premium, it's going to say debit insurance, that's an expense. Expense increase where? On your debit side. Then credit bank, because of cash is going out. So if cash is going out, it affects an asset. Bank is an asset decrease where? On your credit side, right? Then by the 31 December 2021, the company will need to process a journal so that they can adjust for that insurance. Because of this insurance of 12,000 was paid for 12 months, which ended on the 28th February 2022. As the financial year period ends on the 20th December 2021, it means 2 months are left before the company can be able to be covered on insurance, right? So it means the company has got the right from the insurance company to receive that insurance cover for the next 2 months after year period. That's why it's going to be a prepaid expense. And that prepaid expense is an asset, right? Why is it an asset? Because the company has got the right to be covered, or it's got the right to receive that payment back from the insurance company. Then the insurance, since it was debited with 12,000, but it was not supposed to be 12,000, since not the whole insurance cover was received throughout the period, only 10 months and 2 months remaining to be covered in the next financial period. Then it needs to be adjusted so that it fairly represents what happened during the year. Then your impact on your statement of profit or loss, operating expenses. Yes, insurance is an expense. It's an operating expense. Then you pay 12,000, you adjust for 2,000. It means the insurance that was utilized throughout the year was for 10,000 rand, not the whole 12,000. Then on a statement of financial position, under assets, classified as current asset. Why current asset? Because it's going to be realized within the next 12 months. We say the insurance that is remaining to be covered is for the next 2 months after year period, right? Then it's going to be under trade and other receivable for 2,000. But the user of the financial statement, when they're looking at this, they're unable to tell what does it relate to this 2,000. That's where the notes come in. Then the notes to financial statements, trade and other receivable, you see prepaid expense, then 2,000. This will show the user of financial statements that, okay, indeed the company paid for a service, but he has not received that service, right? Then we move on. The next one that we're going to cover is debt management, right? So companies use certain measures in order to increase their sales, right? And the one common tool that is being used is selling using credit, or selling the goods or service on credit to their customers, right? So when a company makes sales on credit, the following journal entry is processed. So it will say debit, trade receivable, or debtors control credit sales, right? This is an asset. Why is it an asset? Because the company has got the right to claim money from those debtors or those customers that is sold them on credit, right? Then we're going to look at provision for bad debts, right? So companies have realized that not all those debtors which it has sold the goods on credit are going to be able to pay or are likely to pay. So the whole reason behind it is because of it may happen that the customer may be affected by certain conditions of the economy, like maybe they may be retrenched, or maybe they may be affected by, at the time of this video, there was coronavirus in South Africa or the whole world, and then certain companies has closed. So it means people have been retrenched and they lose their jobs. So what will happen to their debts, right? So company, before that event can be able to happen, company make estimation on how many debtors will not be able to pay. And this estimation is called the provision for bad debt, right? So once this estimation is being made, users of the financial statements will be interested to know what is the value of the amount which debtors are unlikely to pay, right? So that's why this estimation is being recognized in the financial statement, so that the financial statement can be able to present to the users of financial statements on what's the estimate on those customers that bought on credit that may be unable to pay, right? So we'll see that in an example, right? Say a company made credit sales of about 150,000 during the year, during the financial period, right? Then the company policy outlines that 25% of its debtors are likely not to pay. Then the financial period ended 31 December 2021, right? Then we are told, what is the provision for bad debt? What did you say? We said provision for bad debt is an estimate of how many of your customers that you sold on credit will not be able to pay that debt back, right? Which the company says it estimated to be 25%. So it's like it made credit sales of 150 and 25% won't be able to pay. So it means 37,500 won't be able to pay, won't be able to be claimed, or won't be is likely not to be claimed from the credit sales or from the customers that bought on credit, right? So this means that of the 150 that the company sold to its customers on credit, 37,500 is estimated not to be paid by the customers, right? Then what journal entry will the about transaction be accounted? So when the company makes that credit sales of 150, it's going to say debit trade receivable, also known as debtors control, for 150, then credit sales of 150, right? Then it makes an estimate of 25%. Then it's going to say debit provision for bad debt, which goes to your statement of profit or loss for 37,500. Then credit provision for bad debt, that goes to your statement of financial position of 37,500. This is a contra account. A contra account is an account that has got an impact on a permanent account. A permanent account is like your assets. It's like your trade and other your trade receivables. Like, remember in asset, but we're going to cover that more when we are doing a depreciation. Your accumulated depreciation is a contra account to your assets, so that assets, it can be presented in the financial statement on their net balance, but we're going to account for that, right? So how this provision for bad debt is recognized is that your users will be able to say, okay, as much as 150,000 is being provided to customers on credit, right? There is an estimate that 37,500 won't be able to pay. So the net is the difference between the two, but we'll see on the next slides. Then it means on your debtors control, general ledger, when the sale is made, it's going to be like, you'll debit your debtors control with 150, then your narration is sales, right? So that's the only transaction that happened. You balance both sides, 150 this side, 150 this side, then become a balance carried down of 150. Then becomes a balance brought down of 150, right? We have a general ledger, debtors control, balance brought down 150, because these are the credit sales that you've made throughout the year, right? Then on your provision for bad debt, that goes to your P&L. You say provision for bad debt, debit provision for bad debt is 7,500. So because this one is an expense, and it does not have a closing balance, so it's closed off to net profit because it's a nominal account. Remember, we said expenses don't have a closing balance because they are nominal account. They are part of an aggregate whereby it's going to be determined a net profit that is going to be taken to retain earnings. If you still remember from our previous lectures, right? You can refer to I think lecture 2 is that's where this concept was covered, where we say expenses and incomes don't have a closing balance, but they are there to be they are close off to net profit, where it's going to be close off to your retained earnings, right? Then for provision for bad debt, that goes to your statement of financial position. It's going to be credited with 37,500. Then you balance both sides, balance carried down 37,500, balance brought down 37,500. This is a contra account. We'll see how it affects your account receivables or trade and other receivables, right? Then on a statement of profit or loss, you'll have this provision for bad debt for 37,500. Then on a statement of financial position, you'll have under current asset. Remember, we said current asset are those ones which you are going to be realized within the next month, the next 12 months. So if your debtors are being provided with credit, we expect them to be paid within the certain period. Usually it's less than 12 months. That's why they're classified as current assets, right? So they're recognized at the net balance. Why? Because of, we say this is 150 that is being sold, 150,000 is being sold on credit, but we estimate that 37,500 is unlikely to be paid. So the best representative to your users is to show the net debtors or the net trade and other receivables of 112,500, because this is the what you are certain about. There's no based on your estimation, this is very likely to be received from your debtors. Right? Then, when the user is looking at this, it does not give much information, right? But when it's looking at the notes to financial statements under trade and other payables, you'll see that there's a trade receivables, debtors control of 150,000, right? Then there's a provision for bad debts for 37,500. So it means 112,500 is the amount that is expected to be received. So when the user is looking at this, you'll be like, okay, the company make credit sales of 150, but it expects to not collect a certain amount because of certain uncertainties that will affect the customers not to be able to pay. And that estimation is 37,500. So this 112,500, that's the best estimate on what is actually going to be received, right? Because if you only show 150, even though you know that certain customers that may not be able to pay because of certain conditions, if you present this one 150 only, it will be misleading to your users of financial statements, right? So we say, what will happen in the next year, say 2022, right? So remember the previous year that we covered, it was 2021, right? So now we are in 2022, right? So, and remember in accounting, if a closing balance, last year closing balance become this year opening balance, right? So we expect that when we run a report on the accounting system to reflect the statement of financial, as below, right? We can ignore the retained earnings, etc. So if you run that at the beginning of the year, we run the statement of financial position, we'll expect to see current assets, trade and other receivable of 112,500. This is the opening balance for the current year, because the opening balance for current year is the closing balance from the previous year, right? Same concept to the notes. The notes will show the same thing. At the beginning of the year, it's the closing balance from the last year. Remember last year we say they sold 150,000 credit sales. They make provision for bad debt of 37,500. Then the net debtors control is going to be 112,500. Right? So we say this, what happened in 2022. We say, okay, the company made additional credit sales for 85,000 during this year. Then we are told that only 100,000 was paid by the debtors from last year. So of those 150,000, only 400,000 was paid. 100,000 was paid from the last year balance. Then the company expects the provision for bad debt to be 30%. So based on this estimation, last year it was 25%. So this year, say, hey, things are becoming rough to our customers. Some of them, they don't pay in time. Some of them, they are not responding to our request for demand letters. So there's a probability that more of these customers that are remaining won't be able to pay. So we increase our estimate to 30%, right? Then we are told that what is the provision for bad debt balance as at 31 December 2022, right? So remember I say opening balance 150,000, additional debtors 85,000, payment from debtors 100,000, closing balance as at 31 December 2022 135,000, right? Then we say the provision for bad debt, the estimated debtors who may not be able to pay is going to be 30%. So 30% of 135 is going to 40,500, right? So this means that the closing balance of the provision for bad debt, let me just move this screen. This means that the closing balance for the provision for bad debt should be 40,500, whereas the opening balance, which is equal to the closing balance from last year, is 37,500. Thus, the provision for bad debt is increased by what? 3,000. Then the journal entry that will be recognized will be debit provision for bad debt 3,000. This is an expense because now the company has got more customers that are likely not to pay. So it's going to reduce it's likely to reduce the company net debtors that are being expected. Then provision for bad debts credit 3,000. Narration is recognition of provision for bad debt. Right. Then in the general ledger is for trade and other receivable or debtors control, we are going to say opening balance is a debit of 150,000. Then we are told that we made sales of 85,000. Then we are, because this is an asset account, when the customers make a payment, it reduces the trade receivable by 100,000. Then when you balance both sides, this one is the greater side. The debit side is 235. You balance this side 225. The net becomes a balance carried down of 135. Then your closing balance is going to be 135. This was supposed to be balance brought down. Sorry for typing error. Then provision for bad debt, profit or loss, just provision for bad debt, 3,000. Same concept, just becoming an expense, that movement. Opening balance last year, closing balance this year. This is where that 3,000 comes from. We said the provision for bad debt, that contra account is going to be 40,500. Last year it was 37,500. So it means the difference is what? 3,000. Then the provision for bad debt in your statement of financial position, balance brought down from last year is 37,500, as you can see. Then provision for bad debt is 3,000. Then your balance carried down is 40,500 because this should be your closing balance, 40,500, balance both sides, right? Then on your statement of profit or loss, provision for bad debt, just a movement of 3,000. Then statement of financial position, same concept. We say your trade and other receivable is going to be 135 minus 40,500. Where does this 135 comes from? It comes from here. We just go back. Go back. Yeah, it comes here. We say opening balance plus additional debtors minus the payments, 135,000. Right? $135,000 minus 40,500. Right? We say 40,500 is 30% of 135,000. Then the net debt is going to be 94,500. But when your user is looking at this, won't be able to tell what's really happening. If this was not there, the user, because in the financial statement, you don't show this bracket, you only show this amount. So that's why they say no, so that the user can be able to tell what's happening. Then the notes will be trade and other receivables 135,000, provision for bad debts 40,500. So your net debt tax is 94,500. So the debt, your user financial statement, when you're looking at them, they'll be like, okay, the company made as at the 12th December 2022, the company had trade and other receivable of 135, meaning this is how much customers owe this company, 135,000, right? Then provision for bad debt. This is an estimate on how many or how much in value are those customers unlikely to pay. Only those worth 40,500 won't be able to pay, right? Then only the ones that are very likely to pay are 94,500. The whole reasoning behind this estimation is so that users can be able to see the probability of the company being able to collect the money that is due to them, right? So if they don't make an estimate, an economic condition changes. So a company can move from having 135 debtors, 135 value in debtors, then suddenly it just becomes zero. So in order to make that estimation, the user can be able to look at this, right? So if this amount is high, the user will be like, no, it means this company does not have a good debt management, right? So because there's a high percentage that is unlikely to pay, so it means the company just giving people credit even though they are unable to pay. Then we move on, and we're going to cover bad debts, right? So bad debts is when a company it's when a company provided its goods or service on credit to its customers, right? And remember, if that's the case, it is subject to risk that the customers may default, meaning the customers may not be able to pay, right? Then in the event where the customers are unable to pay, then it means the company won't be able to collect that money, right? Then what company will do will try to send reminders to customers using SMSs. I think some of us knows about those SMSs or calls, like remember you are owing this spot what shop this amount, please pay, it was due on a certain amount, etc., right? Or sometimes you'll be called by certain agencies. They'll be like, hey, so and so, you're representing this company, and they say you owe them, right? Then after all those measures which the company tried to collect that debt and you are unable to pay, then the company don't have any other alternative but to write off your debt, right? Then this is when the bad debt occurs. You owe the company try by all means to collect the money, but you are unable to pay. The company don't have any other choice but to write off the debt. So that's what the bad debt is about, right? For example, say company A sold goods on credit to company B for 150 during the 2020 financial year, right? And during the 2021, company A received a letter from the liquidators asserting the liquidation of company B. The liquidators outlined that only 20 cents for every rand owing by company B will be paid to company A. So this is what happened. There's company A and company B. Company A sold goods on credit to company B, right? So company B is owing company A. Then the liquidators are those people who are appointed to liquidate, meaning this is when they come. It happens that you are unable to pay your creditors will apply for liquidation of your company, right? Then they'll appoint the person who's going to liquidate. Then the liquidator will try to sell the asset of that company that is struggling. Then from there, based on the ranking of its creditors, it will pay each creditor based on the rating, the ranks. Say they'll start paying the employees of that company, then it will start paying the loans from the banks, maybe pay tax that is due to SARS, etc., right? Then here we are told that the liquidators then come to company A, say, like, hey, company B is unable to pay you guys. So as we will try to say, every 1 rand that company B is owing you, we are going to pay you 20 cents, right? Then you are asked what amount will be written off as bad debt, right? Remember that debt it was 150. Then we are told that liquidators are going to give 20 cents for every 1 rand. 1 rand is how much? How many cents? 100 cents. Apples and apples. So it's going to be 20 cents divided by 100 cents times 150,000 because the company B owes what? 150. Then it means company A will receive only 30,000, right? So the debt that is written off is how much? 120. Yes, because of it owed 150. Company B owed 250, but the liquidators were only able to pay 30,000. Sorry for typing error. It was supposed to be 30,000 there. Then it means it's left with 120 that is being written off. Then what journal entry is going to be processed? Company B, no, company A is going to receive cash from those liquidators, right? When you receive cash, what's happening? Debit bank, because the bank is an asset increase where on your debit side. Then credit trade receivables. Remember, trade receivables is your asset. So if now the trade receivables is being reduced by the payment by the liquidators, it means he has to be credited. An asset decrease where on your credit side, right? Then we're left to 120, right? Then we say this 120, you're going to write it off, right? We write it off, it means that debt is no longer there. So if it's written off, it means trade and receivable is going to be taken from, it was 150, then it's reduced by 30, then only 20 is remaining, reduced by 120. Then you debit your expense called bad debts, 120, right? You see the general ledger, trade and receivables or debtors control. It had a balance brought down of 150, right? Then bank, that's when the liquidators give 20 cents. Then the bank, it reduces by 30,000. Then the other one is written off 120. See, there's no balance brought down taken forward. So it means the debtors control is 0 now. Then your bad debt is an expense increase on the debit side, trade receivables 120. As we say, expense and income don't have closing balances, so they are close off to net profit or profit or loss, so that you can be able to determine the amount that is taken to retain earnings. You can refer to lecture 2 where we covered this in detail. Then in your statement of profit or loss, under operating expense, you'll see bad debts, 120. So the user of the financial statement, when they're looking at your statement of profit or loss and they see bad debts, they'll know, okay, the company has written off certain debtors, right? That's what the bad debt is about. Then last but not least, we have bad debt recovered, right? So this happens when the debtor which the company had already written off comes back and replace the amount that was written off, right? So there's this company, it was owing us, we write that bad debt off. Then the company comes back like, okay, I'm back. I was able to survive COVID-19 situation, so I'm going to pay you guys back. Then they pay back. So, but I'll elaborate this more on an example. Company A noticed a bank deposit of 15,000 in their bank account, reference company C, debt payment. PMT means payment. Then on investigation, it was found that company C debt was written as a bad debt during the previous financial year. So it means last year, company A was like, hey, company C is not paying, so let's write them off. Then they write them off as bad debt. Then come this year, the company C comes back like 15,000 on your bank account, here is it, right? Then it means the company now has got recovered that debt that is got written, that bad debt that it was written off the previous year. Then what journal entry will be processed? It's going to be debit bank because cash is coming in. As I said, always you must start with the easier journal side of things. You ask yourself what is happening. Cash is coming in. If cash is coming in, that affects which account? It affects your bank account. Bank account is what? It's an asset. An asset increase where on your debit side. Then the remaining will be the credit, because for every debit, there must be a credit. Yeah, that's what accounting, debit and credit. Then bad debt recovered 15,000. Why? This is an income because now they are receiving income. Then your general ledger for bad debt is supposed to be a bank 15,000. Bad debt is your income, then it's closed off to your net profit. I think I've elaborated this more. No need to elaborate even more why the income and expenses are closed off to net profit. Then on your statement of profit or loss, under incomes, we'll expect to see bad debt recovered of 15,000. So the user will be able to say, okay, the company received other incomes, and this other incomes relates to bad debt recovered. So it means there was a bad debt that was written off. Now the customer came back and pay. So this is an income in this current year. The bad debt has been recovered, as the name says, bad debt recovered. Right? So we are recapping. So we can recap that in this lecture, we've covered adjustments to financial statements, why the adjustments are there. They are there to ensure that your financial statements are accurate and they are free from error and they don't present incorrect information, right? And this adjustment includes your income receipt in advance, your accrued expenses, your prepaid expenses, and your debt management, right? So yeah. In the next chapter, we are going to cover correction of errors, your inventory management, and we'll cover in detail fixed asset register, which covers depreciation methods, disposal of sales of asset, etc. Right? So see you in the next chapter. Thank you very much.